The bears must be absolutely livid with today's price action, finally getting a gap down, opening drive lower, only for the market to completely reverse and close at the highs of today's trading session. Nothing bearish about that whatsoever. The S&P sectors continue to display risk-on behavior, the market internals are supporting the underpinnings, and the breadth indicators that we look at in multiple different charts as well continue to be more bullish than bearish. We'll explore all of these data points objectively in today's session. One of the big uncertainties, though, as we head into the remainder of the week, is the PCE inflation numbers that are set to come out on Friday morning, 8:30. We'll be live on the channel to see the market's reaction, but let's just consider if the chefs out back cook us up an expectation that is so far outside of the realm of possibility. Let's say we miss the expectation. It's a very easy out for Jerome Powell to say something like, hey, just following the data from PCE, inflation's still not under control. We're going to have to hike 50 basis points in February and continue for higher and longer than anyone was expecting. Now, I don't want to be too tinfoil hattish, but the market would not like that. Could it be the case? Again, we don't know. We're playing this as a binary event. We are not positioning ahead of time, but be prepared. The main message of this is, right, be prepared for some volatility on Friday morning, 8:30, when the PCE numbers come out. With that said, a quick thumbs up on the video goes a long way to support the channel, and we'll dive right into the price action analysis. What do we see on the SPY daily time frame chart? Certainly a strong close at the highs of the day's session. We pointed that out already, but it's also above the weekly resistance trend line and back above the daily 200 SMA, the green moving average, after failing it in the morning opening drive lower. So the close up here at the highs does strike me as being really positive. We're also just shy of this breakout point, which is $400.50. If we take out our Fibonacci's from the low of the breakout candle here back in early January and go to the high of this overall move, notice that the pullback was right to the 38.2 on today's trading session. It's also that infamous 393 level, which we know represents the bottom of the prior overhead balance from here, the resistance from here, and the support from these multiple days that consolidated above before the retail sales report, which of course sent us on that micro breakdown from last week. Now, the other thing from a trend perspective that we should be considering is that we remain in a firm uptrend with lows, higher lows now, supported by the 50 SMA and that level we just discussed, 393.50, and we've got equal highs at the top. So what the market should or wants to do to preserve the uptrend is break out and find a new higher high, then allowing us to ultimately search for the next higher low. The market would then be able to sell off a little bit and not be in jeopardy of losing the new and budding uptrend that we're looking at from here to here. Don't get me wrong, there's still an opportunity for a lower high from here to here if we violate these lows. You know, we could talk about on the weekly chart all day long, but in the nuance into the remainder of this week, this little higher high phenomenon that we just described is the primary objective of the market. Now let's have a look at the hourly time frame chart. And what I want to point out from this perspective is really the failure from the sellers. So failure number one from the sellers is opening on a gap down, failed pop higher on like the first 5-minute bar if you were watching, right? And then some selling pressure in the downward direction. The fact that the sellers could not materialize on that momentum and break underneath 393.50 strikes me as the first major failure. Failure number two is the fact that on the gap close right here, there technically was some selling pressure. You can see it in the upper wick of this hourly bar here. From there, there's no follow through in the downward direction. And as a matter of fact, the very next hourly bar engulfs the entirety of that upper wick, not the full bar, but just the wick, and closes strong inside the Tuesday range. So once again, if sellers were going to step up and do something, it should have either been on the morning momentum or off of the gap fill reversal. Simply was not the case, and we know the rest is history. We grind into the highs for the remainder of today's session, closing right up at that breakout point, $400.50. Now that's adjusted slightly higher from $399.75 that we pointed out in the weekly watch list video from Sunday. And the reason being is that we have a poor high from Tuesday, which we'll explore on the market profile in just a moment. So overall on the daily time frame chart, more bullish than bearish data points are stacking up that I can see, right? We've objectively pointed out a failure from the sellers here and a failure from the sellers here on the gap fill reversal, which also, by the way, on the daily chart, would have kept us underneath the weekly resistance trend line. Simply was not the case. More bullish than bearish on the SPY daily. Let's have a look at our internals now and see what this is telling us. For those who don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. What I want to point out is, although yes, today was very bullish, nice strong rally off of the lows on the morning pullback, the main takeaway is that the market's really been consolidating here and we're not seeing significant outflows, right? What would be a completely different story is if on Tuesday per se, as the market was going sideways, we actually saw a volume read that was negative, indicating that across the exchange, right, there's more outflow than inflow. The fact that it was quite neutral on Tuesday leads me to believe that this was actually healthy consolidation. Of course, we know that this is primarily based on Microsoft's earnings forward guidance. We'll have that discussion in just a moment. But without the bearish outflows on Tuesday, no one's really selling this market all that aggressively. Look at how we closed the volume read on today's session. I mean, it's not bearish whatsoever, even though we were gapping down and had the opportunity for some serious outflows in the morning session. The fact that buyers turned it around from here does strike me as being quite positive. Now, again, we're not printing things that are rainbows and butterflies. Let's, fly to the moon, over 300 million, but not as bearish as it could have been. We're really highlighting the failure from the sellers. Advanced decline lines, same idea. We opened down below in trend zone. If the bears are going to take hold of a gap down like this, they should hold prices across the exchange underneath the prior day's close, and you should not see some sort of aggressive trend in the advanced decline line. Once again, indicative of a failure from the sellers. And even if we look at Tuesday's activity, hovering around the zero line instead of spending much of the day underneath, even doing something that was choppy, right? Technically we go positive here means that across the entirety of the exchange, things aren't as bad as they may seem. It's actually quite neutral, right? So once again, no bearish divergence on the consolidation day from Tuesday, and some big improvements actually marking, yes, some solid trending type things happening on today's session supporting the rally. This is not, no major divergences out there. Now, in the tick, I'd like to just focus on today's session because, again, the tick will never lie to us. Notice the clean trend, right? What would this tell us? Well, it's not like this is just short covering. There was sustained buying into the entirety of the day, right? This rally was supported by sustained buying. It's not like we had, something that was doing this downward trend in the tick and nobody was interested in buying into the close. There was buying throughout the bulk of the day's session here, and we can see that reflected in the cumulative build, right? Quick recovery from the open, and we closed solid over that 2,000 mark. It's not the most impressive read from a net build perspective, but the fact that, again, we're rallying off of a big gap down, it would just be indicative of an absolute failure from the sellers to push prices in the lower direction. So that was a pretty in-depth breakdown of the internals for today's session. I do believe that probably merits a thumbs up on the video, but let's continue along through the analysis. What does the market profile tell us? Top right-hand corner's got us covered with a brief tutorial if you don't know what this one is. Overall, the main takeaway from the market profile would be that value area was not lower in the profile. Notice that value area is here. Value area from Tuesday is here, higher in the profiles instead of lower. Point of control is higher on Tuesday. Point of control is higher on today's trading session. Again, if the bears were going to do something impressive, they, number one, should not have allowed price acceptance back in the prior day's range, but they also should have been able to commit more volume down here at the lows, getting more price acceptance. It simply was not the case. Point of control is higher on today's session. There is a poor high on Tuesday that we discussed. You can only see one tick of excess on that profile, which is why we adjusted that breakout level lower slightly. In your ES, it's going to be about 40.42. 40.42, breach of that could repair the poor high from Tuesday, and I would watch for a quick pop over that and then evaluate whether or not momentum is coming in. In terms of the lows, good excess all this week. Good excess on Monday, good excess on Tuesday at the lows, good excess on today's session at the lows. There's no structure to quote-unquote repair down there. I wouldn't imagine that prices need to re-auction towards that area. Let's go back on over to the platform and blast through our S&P sectors. The percent change on the week is also striking me as a bullish data point here. And again, we're being very objective. If the data points were bearish, I would point them out as bearish. They simply aren't. So perma bears accept the fate of what's in front of us on the screen, but us bulls out there will also be cognizant of the risk of PCE inflation data on Friday. Anyways, back to the sectors. Notice what's leading the pack for the week. It's the XLF, which is definitely a heavier weight risk on sector. XLC is more risk on. After that, we see the XLY. XLK is towards the top of the list. At the bottom of the barrel, which is no longer at the bottom because of the sorting feature, we've got the XLE. The XLE is a risk-off sector that's lagging the market. The XLU is lagging the market. The XLV, although one of the second heaviest weight sectors in the S&P, we know it's slightly defensive in nature. It's still lagging the market. So defensive names at the bottom, risk-on names at the top. Let's see what the structure continues to tell us about what we can expect going forward here. And the main, again, I sort of think about themes when we're discussing sectors and the structure of markets. The common theme for the sectors, then we'll speed up through the remainder of them, is the cup and handle pattern or the bull flag pattern, or you could call it the higher low equal high breakout pattern, right? This is what we're looking for across the sectors. Many of the risk on sectors that we really care about just found a higher low, and we're looking for the equal high break. So in the XLF, can we see that as a reasonable outcome here? Absolutely. Just like we talk about the resistance trend line in the SPY breaking in short proximity of time or being an increased factor for the break, short proximity of time test versus long proximity of time test, this would increase the odds of a bullish break. Here we're watching 36 in the XLF. Now, a pullback at this point in time, if the market does come in off of that level, it would of course keep us neutral into the remainder of the week, but we wouldn't really be bearish in the XLF until 3450 breaks down, until this higher low fails. So quite a ways to go before the XLF flips completely bearish. Anything up here really keeps us neutral and continuing to scout the breakout of 36. For a picture in perfect pullback now, another higher low on the daily, staying over 35.30 would be bullish for your XLF. All right, truly speeding it up now. XLC, it's all about the gap overhead, breaking the 200 SMA here as well. Bull flag completely in place, but even with that structure, we could afford a higher low that just stays above 52.17, which is the upper edge of this balance from here. We'll leave it at that. Pretty self-explanatory in the communications sector. XLY, of course, Tesla earnings after the close, so we'll see what that chart is looking like in just a moment, but there's your higher low, looking for the equal high break. Does it look reasonable? Absolutely, with the lower wick of today's session testing this, and then closing back up at the highs. Looks to be a pressure cooker top. The level to break here is roughly, let's grab the other tool. Level to break in your XLY is going to be 141.75. Over that opens up the door to the top of the range, 148. Bullish pressure for your S&P. XLK, tech sector, heaviest weighted sector of them all. Notice again, the pullback violates this low. No acceptance from the sellers. Easily a higher low on the daily time frame chart. Equal high break is over 135. It would also be getting us out of this prior overhead supply. Very, very bullish if the XLK can get over 135. Not the end of the world if this wants to consolidate somewhere in here. At this point, anything that stays above today's low, which is at 130.75 roughly, keeps us in a rainbows and butterflies bullish type situation. Underneath 128.25, definitely reconsider, and we'll of course change our tone if we get a lower high and a breakdown of that level to being slightly more cautious or bearish if the remainder of the sectors are in alignment with that. XLI industrials, we talked about this one going really more sideways in a range, noting that we failed to hold that 99 on the pullback from last week. We're back above it as of right now, but if you treat this as a range, we're just in the midpoint, no discernible edge in the XLI. I would treat that as neutral. Next up, XLP, consumer staples. We did want to see this lower. We did not want to see it leading the pack, but we didn't want it to go to zero. Remember, downward pressure is still downward pressure for our market. The fact that this is perking up or at least hanging sideways does strike me as a positive data point for our market. Again, not blasting off to new highs, just slowly grinding up. We want to see it lag. We don't want to see it outperform, but we don't want to see it going to zero. Looks good to me. Next up, real estate sector. What's going on over here? Cup and handle pattern is clear as day. Breakout point is clear as day. 39.85. Breaching that is positive for the wealth effect and should have a positive impact on the XLY consumer discretionary as folks feel as though their net worth is being preserved based on home value. Next up, XLB material sector. And by the way, XLRE in terms of its explicit percent weighting in the S&P, very, very small. Much more to do with the wealth effect, right? So I want to be clear about it not being just a blatant bullish sign that we're going to highs, so to speak, if that level breaks. Anyways, XLB, same thing, lightweight material, lightweight sector materials here, less than about 2.5%. Break of those highs is bullish, though. Of course, it will help propel your market in the upward direction. Anything that stays over 80.75 at this point is still a good look for the XLB. XLE, just going sideways in the range here. Nothing to see. D for defensive. It's risk off. We want to see it lagging the market. We don't want to see it going to zero. This, just like the XLP, looks great. Next up, XLU, utilities. Same idea as the energy sector, so we won't beat the dead horse. Want to see it going sideways. We don't want it going to zero. You know the drill. Looks good to me. Next up, XLV, perhaps worth spending a little bit more time on simply because we know it is second, I should say, in the lineup of heaviest weight sectors. This is really, I don't want to say concerning, but starting to become something we should pay much more attention to. The fact that this did not turn into a look below and fail. It did not rotate to the top of the range. We're actually back down underneath 133.50, keep a close eye on the XLV. It's going to be very hard to have a blatant breakout in the S&P if the XLV healthcare sector rejects here off of that 133.50 and actually moves lower underneath 130.50. The XLK, XLY, XLF could all be nice and bullish, and certainly, don't get me wrong, we're not looking for a market Armageddon, so to speak, if that's the situation, but the breakout will not be as powerful if the XLV is not participating. So watch this one like a hawk around that 133.50 level. As of right now, again, based on the first look below and fail not playing out in the upward direction, little bit skeptical of what we're seeing going on here. All right, so those are the sectors. Let's have a look from a ratio perspective, see where there's relative strength, relative weakness. Oops, that's the same thing we were just looking at. Ratios, here we go. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. Very simply put, the top four are the risk-on sectors. Look at the massive improvement in the XLK back up at these highs. Again, we're not fully out of the woods yet, but this, of course, is much more constructive for risk-on than putting in some sort of lower high underneath the 50 SMA gold line and rotating back in the downward direction. This is a big improvement. XLV, as we just saw, a little bit of a threat to our market at this point in time, but of the heavyweight sectors, this is the one that has more of that defensive posturing to it, so not the end of the world. XLF did find that higher low off the daily 50 SMA gold level here, looks good. XLY spending more time over the descending 50 SMA with a very nuanced higher low there. Once again, this is becoming more meaningful. Instead of just being a counter trend rally, it could take on the beginnings of a new full-blown bullish rally, a reversal in this ratio grid. XLC, risk-on sector that we know, right? That's also pointing in the upward direction strongly. Bottom four sectors are the risk-off sectors. XLP is falling off of a cliff, so is utilities. Energy is flat. Real estate's kind of flat here as well. Risk-off does not seem to be an imminent threat at this point in time. Let's have a look specifically at growth versus value in our XLY over XLP ratio. Continuing to be pleasantly surprised and enthused about better than expected outcomes as this rotates higher and becomes more than just a counter trend rally. Very similar to the XLY ratio on its own. Remember that this represents growth versus value, and as this moves in the upward direction, it's typically more bullish for our markets, supporting a growth-oriented environment where the market can actually rally and see sustained rallies instead of a defensive rally, right? So overall, this is helpful for the bullish narrative. Let's have a look at the DXY, the dollar. Dollar is actually quite interesting based on the pattern unfolding. I would start to look at this as a falling wedge, which is actually a bullish pattern, right? We know that that represents the slowdown of the sellers pushing prices in the downward direction. They're making less and less progress, so to speak. And what we're looking for is possibly a break of that pattern for a retest. We want to find resistance if you're a market bull at 103.50. At 103.50, if we can put in another daily lower high, continuing this trend here, of course, that would bode well for equities continuing in the upward direction. If it's not so clear on the dollar, you can definitely have a look at the GC, and you'll notice the same exact kind of thing. We're still in an uptrend. Don't get me wrong. The breakout from this balance is still strong, but noting that we are starting to get a little bit of that rising wedge type pattern, something that looks like this, it could break down. And once again, as long as we produce a higher low in the grand scheme of things over 1820, higher low preserves the uptrend, preserves the breakout, which of course is bullish for equities, meaning downward pressure on your dollar. So hopefully that wasn't too confusing to follow, but that's the rough relationship. Next up is the TNX. Let's talk about rates now for a brief moment, right? So we still have the phenomenon of lower highs on the weekly time frame chart. Equal lows, so a descending triangle, looking for that to break down, would of course be bullish for our market, relieving some of the pressure on the tech sector specifically. And let's talk about the Fed tool, the Fed Watch tool, and what we have going on here. As I pointed out in the weekend update, the site itself had updated before I was able to record it, but it's back to what I was talking about. There's actually some very razor thin possibility of the Fed keeping rates flat, no change in the upcoming meeting. Now, I personally don't think that is likely whatsoever, and the market doesn't either. You can see a 99.8% probability we will get 25 basis points as a rate hike. Now, something interesting and worth observing is what happens to this probability after the PCE numbers come out on Friday. So we will update you on that in the weekend update, but for now, nothing's really changed here in the markets. We're expecting still that terminal rate at 500 basis points and cuts in the latter half of this upcoming year. When it comes to earnings, right, because we're We're in the heat of it now. Notice that the earnings beat data is actually getting back to normal, right? We're at 66% beat rate, which is typical of a market, but something unfortunately that this tool does not do is track forward guidance. So FactSet does do that, right? And guidance as a percentage of companies issuing negative EPS for Q1 is above. It actually is above the 10-year average. And you can see that here. Where are we? 71%. And I totally understand that it's still very early, right? We're dealing with a sample size of 7. It's not very broad. I completely concede that point. But 71%, 5 out of the 7, have guided negative or issued negative guidance going forward, which is above the average of 59%. Okay. So anyways, the point is forward guidance is what we need to continue to keep an eye on. And that's what we'll do. So I will continue to update you based on the insights that we can gain here. Now, one of the conversations that we had in a previous video is the market is pricing in rate cuts or, a terminal rate of 500 basis points, which could be completely contrary to what Jerome Powell is about to come out and say based on PCE inflation. The market is right is one case, and the market is wrong is another case. In both of them, we know that there's more pain ahead. This will be like ripping the Band-Aid off. This will be a long and drawn out process. One thing I want us to consider is much more of a contrarian view, all right? So everybody is saying it's going to be impossible for a hard landing. The yield curve is so inverted. There's going to be a recession no matter how you slice the cake. Let's think about this. Here's a view of the performance of Treasury bonds versus the S&P 500 peak to trough in major drawdowns for our market. Complete credit to Michael Gayad over at the Lead Lag Report for putting this chart together. But we've just experienced something that has never happened before in history, right? Where bonds actually outperform in the downward direction, or I suppose you could say underperform equities, which is a relationship that's never been observed before, even in cycles where the Fed is tightening, right? So if we've just experienced something that has never happened before, would it be possible that the yield curve could be wrong this time around? And although, yes, it has predicted almost every recession in the past, could this be the time where it doesn't? Again, I'm not here to come out and completely persuade you in the opposite direction. I just want you to start having more of an open mind based on the data we're also seeing in the market that actually looks quite bullish, right? So unless things dramatically deteriorate, could we experience another outlier event? It certainly is possible, right? Certainly is possible. And along the lines of thinking like that, let's see what the business cycle might have to say about something like that, right? So we've talked about in the past on the channel how commodities want to break down first. They are not breaking down, right? Commodities are not breaking down. And you can see that TLT bonds are actually threatening a reversal here. We've already got the higher low. We just need a higher high, and then we're technically in an uptrend on the TLT, right? So if this reverses, this already has our higher low. If we can get that higher high, does that mean that we don't necessarily need commodities to move lower? Will inflation sort of run higher than the expectation as commodities remain elevated? It's a possibility. Once again, what history would tell us is that this is very unlikely. But based on what we just experienced in the last year's worth of trade, where we had a never before seen underperformance of bonds versus stocks, equities, could we see something again that's just never happened before? It's a possibility. Once again, I want to be very clear. I'm not a proponent that all of a sudden things are fine and dandy, we're going to the moon. I don't want to sound like that, but it's just something to think about, okay? Next up, TLT, on the subject of bonds. Is the TLT outperforming the SPY? The answer is absolutely not. There is continuing to be no flight to safety trade unfolding. How's our risk appetite doing? Let's move through these a little bit quicker. HYG continues to stay elevated. No pullback as we saw the pullback here. Again, that's more indicative of strong risk appetite. One additional chart that we have not talked about in quite some time on the channel is, drumroll please, the Bitcoin chart. Right? Bitcoin, not that, again, I want to be very clear about the sort of contrarian views that we're bringing up in today's episode. I don't think that we are going to find a soft landing and magically go to the moon. I don't think Bitcoin is magically out of the woods and all of a sudden has some major intrinsic value. But noting that it is sort of a risk appetite gauge, notice that we actually closed above the prior breakdown bar here from all of the sort of exchange drama, so to speak, and the lack of liquidity in the exchanges. Bitcoin is clearly maybe not outperforming, but clearly, well, yeah, it is outperforming on a relative basis, the SPY, but it's moving in the upward direction, cleared the breakdown candle high. That's indicative of risk-taking behavior. Now, it's not a one-to-one correlation, but you can see as Bitcoin rises, right, and falls, typically your market is getting some sort of gauge, weather bell, so to speak, based on the risk appetite. Now, Bitcoin puts in an equal high here. The market continues, right? Gets a higher high, and then the divergence sets in. Now, once again, not a call that Bitcoin's going back to the moon, not a call that I'm a believer in the cryptocurrency space, but this perking up here is starting to become noteworthy for risk appetite. Another data point that I think stacks up on the bullish side. Let's have a look quickly at some breadth indicators. We're going to look at new highs minus new lows. I want to just point out that there was a threat of the zero line here perking back up in the upward direction. That's positive. If we take a look at our SPX A200R, companies in the S&P over the 200 SMA, threatening a break of these highs, also a positive look for a more bullish market. And then lastly, the SPX A50R, actually second to last. Then we've got the RSP, right? This is still hovering in a pretty solid zone. It's not overbought. We're not contrarian up here around 0.9. We're just staying healthily around 70%, right? So that does look good from that perspective. And then the RSP here, certainly looking decent, right, in terms of the breadth of the S&P. If we take out a couple of the bad apples that are potentially overweight, right, we're actually making an equal high threatening a break there, which of course would be bullish. And once again, you've got lows, higher lows, higher lows. You've got a pattern like an ascending triangle building out. To me, it strikes me as being more bullish than bearish for our market. So once again, not a call, everything's fine and dandy, not a call that we're going to the moon, not a call that we're making new all-time highs. What it is a call for, though, is to be slightly more reserved if you're a bear thinking that the market's going to go to hell in a handbasket. None of the data points at this point in time stack up in that direction. Now let's take a look at volatility, which once again is going to continue to support more of the bull case. Volatility is historically low based on where we were trading throughout the calendar year of 2022. Strikes me that the market is comfortable with where we're trading and nobody's pricing in a massive black swan event, which of course does inherently open us up to the flood effect, which is reflected in the VVIX here. Volatility of volatility is historically low as well right now. So if there is a perk up, if PCE comes in much hotter than the expectation, if it's an excuse for Jerome Powell to yank the rug out from underneath us, expect this to perk up first, then your VIX will follow, and of course we know the deal probably means the S&P is headed lower. So that's the risk. That's the risk at this point in time, but it's just a risk, right? We can't position ourselves based on that. We have to just go with the price action until it says otherwise. Next up, we'll take a look at our futures in volatility, continuing to indicate strong contango. Present day risk is much less than forward risk. And although this is perking up, I would say that the 9-day VIX specifically, those are the two monthly contracts for February and March, the 9-day contract versus the monthly is probably pricing in some uncertainty of earnings there. That would explain sort of the discrepancy between the two. So volatility, not in all that bad of a place either. Let's have a look at some of our other market ETFs here. Broad market ETFs, QQQ NASDAQ 100, same idea as the SPY, closing the gap underneath us, pulling back to the key level, closing the gap above us, and closing inside the prior day's range. Your breakout point is quite literally the upper edge of the weekly expected move at 289.50s. If we can clear it, next overhead resistance is 296.50. In a picture-perfect world, this would not violate today's opening print. It would not go back down underneath 283.75 on any consolidation. That would keep us optimally bullish, but in the grand scheme of things, anything that stays here could be building out a weekly bull flag for the move that would look like this. And once again, I would reiterate that we're finally getting some price acceptance inside of the prior overhead balance from here. We're also above, once again, that weekly resistance trend line. Let's have a look at our IWM Russell 2000 and the small caps. What's going on over here? 100% retracement of this downdraft. We did make it to the top. Higher low has put in place, and the breakout level is the upper edge of this range, roughly around 188.50. If you want to use the true highs from here and also a prior data point from back in here, you're looking at 189.70. 189.70 opens the door to 195.40 once again. If small caps are going to act as a risk-on, risk-off signal, this is definitely more bullish than bearish. Finding the higher low inside of the prior balance range and threatening a break of the highs off of that higher low. Once again, finding a more nuanced, maybe you would call it like an hourly higher low at 184.50 today. Everything about this is saying, hey, buyers kind of in control. I would be concerned about bearish outcomes, and this would actually turn into a double top here if and when we crack the neckline. So we're willing to flip bearish on this market, but only if these patterns start to unfold, only if we start violating some of this structure in here. So hopefully you didn't get the sense that we were overly bullish just because we want the market to go up, but actually the data points and the underpinnings of the market support more of that line of thinking. Let's get into the core list of companies. Apple is up first. What do we see here? Breakout point is at 143. Also a resistance trend line following this sort of trend here from the past couple of months worth of trade. If we can clear it, you would probably look at your first target at 146, and then here is the major target, 149.50, and daily 200 SMA prior highs from this consolidation and congestion zone from the past. Now, the reason we're bullish on this is, once again, look below the prior day's low, failure from the sellers, close back up at the highs, so preferring bullish outcomes, but if we fall down, the bears do get a little bit more of a firm foothold underneath 138. Next up is Netflix. What's going on in Netflix? This is like a balloon floating away, just does not want to stop in the upward direction. We are coming into some congestion from the past, right? You can see all of these levels from in here. I would not be an advocate for new money longs in Netflix. I think the move has been had from the earnings gap up. I would look for higher lows to start to develop and then get on board from that perspective. The best pullback, or maybe not the best, but the most ideal situation is a bit of a deeper pullback at this point of time. Confirm this area 333 as support and then move on up in the upward direction. You can get the sense that that would be confirming the breakout point as support and also respecting the prior lows before the first major gap down that we can see on the screen. Next up is Tesla. What's going on here? Earnings after the close. So let me not bore you with this chart. Let's go to an hourly with our extended hours on and see what's going on here. Let's take a peek in live action. So getting a gap up, shorts are probably getting squeezed. Anyone who is too bearish near the lows, definitely not feeling so fond as of the price action right now. So 152.19 is where we're trading. If we go to the daily, it's right at the 50 SMA here, in between the next two tradable levels that we have. So gap rules will likely be in play if we remain on a gap up for tomorrow's session. We'll be talking about this in the pre-market prep. So tune in at 8:30 to hear the live and updated thoughts on Tesla for tomorrow's trading session. But if you can't make it and you're intent on trading this, if we open on a gap up, you want to see that gap close and support be found there at the prior high of day. That's going to be today's highs, roughly around 146.75. If we can support off of this level, I think that shorts continue to get squeezed and we see a pop in the upward direction. If we fall into the prior day's range, write it off as chop. I would wait for the next setup. Next up is going to be GOOGL. What's going on with Google? Closing the downside gap on today's session, reversing, but unable to take out the opening print and get anywhere near the overhead gap. That's going to be your primary upside watch. Over 96.20 fills up to 97.25. If we just doodle around towards the lower edge of this range from in here, I'm not sure I would be interested in a long yet until we can actually break that high, confirm some sort of pattern like this, next higher low, right? Taking out that hammer high opens the long entry to retest the highs here at 99.50. In the downward direction, it would take a lower high confirmation underneath 94.65 to get bearish in Google, simply noting the lower wick represents an initial failure from the sellers. Don't want to be on the losing side of the trade. Next up is Meta. What's going on with Zuckerberg's fantasy land? You have a breakout level here at 144.50, but just like Netflix, I think this is time to cool off a little bit maybe. I mean, really impressive run off of the last earnings cycle lows. I think that this inverted hammer could suggest a little bit of a pullback tomorrow, breaking down underneath the low. You want to watch for your ideal level to hold at 137.50, reverse off of that for a higher low, of course, equal high as the target, then continuation from there. If we go deeper than that, the concern would, of course, be a head and shoulders type pattern, which would be more bearish underneath 132.50. So keep that stuff in mind on Meta, and those are the numbers. Next up is NVIDIA, NVDA. Again, very hard and difficult to chase this as a new money long up at the highs now that we've gone past the 100% retracement. It is technically building out a bull flag, so don't fight this. I would not fight this in the downward direction, but I would just be cautious, so to speak, with new money longs. I would not load the boat here as a new entering long. I would wait for either further consolidation or a pullback that offers a daily higher low, ideally anywhere over 178.25. Looking to buy that and take part in some sort of bounce off of it. When and if that happens, if you miss it, you could always look for the equal high break after the higher low over 192. Upward targets are 199.75 and then 212.75. Next up is Softy. Of course, reporting earnings this morning, and forward guidance was not great, right? They were one of the seven, or will now be added to the list of one of the seven, who actually guided forward in a bearish manner. Anyways, stock rallied, finding support off of the low from the pullback of last week and closed back up in this sort of area that we've been describing as a choppy zone for Microsoft. It's really got to resolve at this point, right? Like clear lower high underneath 239.25, or just break out over the top of these highs at 244.50 to have something more meaningful start to unfold. So although it was bullish, although we sort of, didn't get anything in terms of the sell and the gap down, it's still stuck in a really tricky spot on the chart. I would just carry forward 244.50 or lower high underneath 239.25. Last but certainly not least is the mini beast. We've got Amazon, and then one additional trade idea for you on today's session. Gap down, supported the 50 SMA, gapped underneath this consolidation range, closed back inside. Technically a look below and fail all in one day. The next trade is bullish, of course, noting the failure from the sellers to hold it underneath the bottom of the range. Also, to hold it underneath the gap fill reversal area, very similar to the psychology of SPY. As long as we're over 96 consolidation and then a break over 99.25 roughly gets us to 104, the bottom of the overhead gap, and that gap closes up around 109.70. I would look for bullish outcomes here. The only bearish one that I could see is recognizing that, sure, if we get a double top, if we get a lower high underneath 93.15, that would put us back in the bear camp. Anything that's just playing around sideways here is exactly that, neutral until proven otherwise. One trade idea, and then you're on your way. This was a long one tonight. Again, a thumbs up goes a long way if you appreciate these analyses, so to speak. What do we see in Boeing, right? Boeing, there's a bull flag, right? Really strong weekly chart as well. Of course, earnings were this morning. But look at the bullish engulfer, right? The reason why this is so powerful is because we technically look after the open. We open inside the prior day's range. We break the prior day's low. No acceptance from the sellers. Rally over the prior day's high. A little bit of a pullback, but where do we close? Above the prior day's high. So from a psychology standpoint, very, very bullish. A failure from the sellers, and a success, so to speak, from the buyers. Now, the next stage of this is breaking out over the highs and confirming like a weekly 3-bar play, right? If we look at it from this perspective, here's 1. Now we've got, 2, 2, 2, 3. The third bar in the pattern, so to speak, would be breaking those highs and getting continuation. The rough measured move would be the same size of this bar stacked off of the low of the pullback. So let's just eyeball it roughly and say that that would be close to 225, just for round number's sake, just shy of the weekly 200 SMA. That would be a measured move target. So that's what I've got for you on today's session. If you appreciated the video, let me know down below in the comment section or by giving the video a thumbs up. Don't forget, we will be live tomorrow morning at 8:30, Friday at 8:15 for the PCE reaction. And with all of that said, I wish every one of you a green trading day.